DMCC Family Office provides a structured platform in Dubai for families that need to centralize the management of companies, investments, property, and succession planning. It can bring decision-making and professional coordination under one legal entity instead of leaving these responsibilities across different advisors and jurisdictions. My name is Shiraz Wahid and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain what a DMCC family office is, the difference between a single family office and a multi-family office, the activities they can carry out, the setup requirements, and how family office can work alongside foundations, trusts, holding companies, and SPVs. A DMCC family office is a company established in the Dubai Multi-Commodity Center that is a free zone to carry out approved family office activities. DMCC provides separate framework for a single family office, commonly called SFO, and a multi-family office, commonly called MFO. A single family office serves one family and support the administration of family wealth, businesses, investments, legal affairs, governance, and succession planning. A multi-family office provides approved services to more than one family, usually through shared administration, technology, reporting, and professional coordination. The family office can act as the central operating platform, while legal advice, investment management, and other regulated services must still be provided by appropriately qualified and authorized professionals. Families consider DMCC because it provides a recognized Dubai corporate environment, full foreign ownership, office infrastructure, and access to professional advisors. The family office can centralize board meetings, document control, professional appointments, and approval procedures. It can also employ staff who manage administration across several family entities and jurisdictions. DMCC Family Office operates with a regulated framework and must comply with the company's tax, beneficial ownership, anti-money laundering law, and reporting obligations. It is therefore viewed as a structured and internationally respected jurisdiction rather than a secrecy-based offshore location. A single family office must be incorporated in DMCC as a free zone limited liability company and cannot be registered as a branch of a foreign company. The family office license is generally treated as a standalone activity and should not be combined with unrelated commercial activities. The family must also demonstrate at least $1 million in investable or liquid assets using appropriate supporting evidence such as bank statements or confirmation from a foreign regulated financial institution. Ownership and control must retain within the same family, and the shareholders, ultimate beneficial owners, and directors must meet the family relationship requirements under the DMCC rules. The legal name of the company must also end with SFO DMCC. Once established, the single family office cannot start serving unrelated families or transfer ownership to parties outside the approved family structure. A single family office can coordinate investment reporting, accounting, cash flow, and family business reporting, as well as document management and relationships with external advisors. It can also support governance by preparing board papers, maintaining records, and documenting how important decisions are approved. The family may introduce investment policy that defines asset allocation, risk limits, and approval authority. It may also use an authority matrix to identify who can approve bank payments, company appointments, property transactions, and major distributions. The team at the family office can gather information and coordinate decisions, but the license does not automatically permit the company to provide regulated investment, legal, or financial services. Those activities must remain with authorized providers when required. DMCC Family Office normally acts as an operating and administrative layer rather than the main ownership structure. A foundation or a trust may be used to hold long-term family wealth and establish rules governing succession, beneficiaries, and control. A holding company may consolidate business interests, while separate SPVs may own property, investments, and other individual assets. The DMCC Family Office can then coordinate reporting, governance, and professional services across these entities. For example, a family foundation may own a holding company, and the holding company may own several SPVs. And the family office may employ the team responsible for administration and oversight. This separates long-term ownership from daily management and allows the structure to continue even when the family leadership changes. A multi-family office can be suitable for established advisory or administrative business that supports several families through shared infrastructure. It may provide business administration, technology systems, consolidated reporting, governance support, and other approved non-regulated services. Each family served by the multi-family office must be approved under the DMCC framework. The multi-family office license does not provide unrestricted permission to manage investments, recommend financial products, arrange transactions, or hold client money. These activities may require separate regulatory approval from the relevant UAE authorities. The services, fee arrangements, and responsibilities of the office should therefore be clearly defined before the company is established. Now, when it comes to the process of setting up a family office, it should start by mapping the family members, businesses, assets, and jurisdictions connected to the structure. You should identify who owns and controls each asset and how authority should pass down during death, incapacity, or retirement. The family can then choose between a single family office or a multi-family office, select the legal legal form and prepare the required governance documents. A single family application will normally include a business plan, information about the family members being served, details of the family businesses and assets, proof of minimum asset requirement, and evidence of family relationships. The application process also includes company approval, document signing, payment fee, and arranging appropriate DMCC office solutions. Banking, tax registration, staff visa, and the transfer of assets are separate at this stage and may have different completion periods. Now, when it comes to governance, the family office should operate under written governance procedures rather than depending on informal instructions from one individual. The documents can define the roles of the family council, company directors, investment committee, and external advisors. They can also establish approval limits, voting procedures, conflict of interest rules, and reporting responsibilities. These arrangements are particularly important when several generation or family branches are involved. A well-designed framework allows the founder to retain an appropriate level of control while creating a gradual process for future family members to participate. Governance should remain practical and proportionate to the size and complexity of the family structure. A DMCC family office is based in a UAE free zone, but this does not mean that every source of income will automatically qualify for a 0% tax rate and meet the audit and filing requirements. The personal tax position of family members can depend on their residency, domicile, citizenship, and the location of underlying assets. Foreign reporting rules and controlled corporation rules, inheritance taxes, and capital gains taxes may still apply outside the UAE. The advice must therefore cover every relevant jurisdiction rather than focusing only on where the family office is incorporated. A family office can improve continuity by maintaining records, coordinating advices, and ensuring that the decisions are made through an established process. However, forming the family office does not automatically transfer personally owned assets into a succession structure. Assets that remain in an individual's personal name may still be subject to probate, inheritance procedures, or local court procedures. A complete succession plan may require a foundation, trust, holding companies, SPVs, wills, shareholder arrangements, and incapacity documents. The correct combination depends on the asset type, ownership location, and the laws of every connected country. The family office can then administer and coordinate the structure after the ownership arrangements have been properly implemented. Asset protection depends on how the structure is created when assets are transferred and the reason for the transfer. A family office company alone does not protect assets that continue to be owned personally or held through unsuitable entities. Long-term ownership structures should be established before disputes, creditor claims, or legal proceedings arise. The transfer made after a claim becomes foreseeable may be reviewed or challenged under applicable law. The family should also maintain proper records showing that the structure has genuine governance, succession, and commercial purpose. Asset protection should be considered alongside tax, control, and inheritance planning rather than treated as a separate promise of complete protection. Now, when discussing the cost, $1 million asset base is a requirement for eligibility threshold for a single family office. But it does not automatically mean that if you have $1 million, the structure will be commercially viable. The family must also consider company setup fee, office cost, staff salaries, accounting, audit, compliance, and professional advisors, as well as annual renewals. A family with one company and limited numbers of investments may be able to use a foundation or a holding company supported by external advisors. A family with several businesses, multiple investment accounts, international property, and more decision makers may benefit from a permanent family office platform. The structure should solve a genuine administrative and governance requirement rather than being created only because the family meets the minimum asset threshold. Before applying, the family should decide which asset will sit within the wider structure, which entity will own them, who will have the authority over the important decisions. It should also define the responsibilities of family members, directors, employees, and external professionals. The DMCC Family Office can provide the central operating platform, while the foundation, trust, holding companies, and SPVs can provide the ownership and succession layers. When these elements are coordinated correctly, the family can manage international wealth from Dubai through a clear, regulated, and documented framework. So if you would like our help and want to explore whether this structure can suit your situation, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.